Good evening, everyone. We'll start with Unit 4 of Financial Risk Management Banking Specialization Semester 4 of MBA Master of Business Administration. Unit 4 talks about financial swaps. We've already understood the concept of financial swap in the previous topic, and we'll study about 5 topics in here: concept, interest rate swaps, options and swaps, commodity and currency swaps, pricing of swaps, basic concept. Let us understand what financial swaps are. Financial swaps. Swap is a derivative contract through which two parties exchange the cash flows or liabilities from two different financial instruments. Most swaps involve cash flows based on a notional amount, a principal amount such as loan or bond. Although the instrument can be almost anything, usually the principal does not change heads. Each cash flow comprises one leg of the swap. One cash flow is generally fixed while the other is variable and based on a benchmark interest rate, floating currency exchange rate, or index price. The most common kind of swap is an interest rate swap. Swaps do not trade on exchanges, and retail investors do not generally engage in swaps. Rather, swaps are over the counter contracts primarily between businesses or financial institutions that are customized to the needs of both parties. Let us understand what financial swaps are. Swap means exchanging the liability of some monetary liabilities. Just imagine, just take this example. Like, for example, I'm in India and I've taken a loan from some bank or some institution. I have got some liability to be paid in UK, and one of the companies in UK has some liability to be paid in India. What we can do is in this manner, what is happening is we both me and that company, we both are exposed to foreign exchange risk. What we both can do to mitigate this foreign exchange risk is we can exchange the liabilities. We can exchange the liabilities. How it is, like, I can pay his due in India, and he can pay my dues in United Kingdom, and this will be known as swap. Now, how many kinds of swap are there? Interest rate swap, currency swaps, commodity swaps. These three are the main kinds of swap we have, that is interest rate swap, currency swaps, and commodity swap, on the basis of the underlying. For interest rate swap, the underlying is interest rate. For currency swap, the underlying is currencies. The For commodity swaps, the underlying is commodity. Then subordinated risk swap, total return swap, variance swap, amortizing swap, zero coupon swap, deferred rate swap, accreting swap, and forward swap. We'll discuss all these swaps in the coming slides. Let's understand what financial swaps. I think we have already done this one. Now let us go for features of swap. Counterparties. Swap involves the exchange of a series of periodic payment between at least two parties. Example: a firm having a loan of 10 crore payable at 10% fixed coupon rate for 5 years want to exchange for a floating interest rate with that party who is also interested to exchange its liability from floating to fixed. So they're just exchanging the their liabilities. Now, facilitators. Swap agreements are arranged through an intermediary, which is usually a large international financial institution, bank having networks of its operation in major countries. These intermediaries play a significant role in bringing closer the various parties for such deals. Facilitators will note down the requirement of the parties and try to match and fulfill these with other parties. Swap facilitators can be classified into two. First one is brokers. Brokers function as agents that identify and bring the customer counterparties on the table for swap deal. Initiate the counterparties to initialize the swap deal according to their respective requirements. Swap dealers. They themselves become counterparties and take over the risk. Swap dealers are the part of the swap deal. They face two problems. First, how to price swap to provide for his service. Second problem is to manage his portfolio. Now, cash flows. Swap deal is an exchange of two financial obligations in future. Both the parties would desire to have same financial liabilities as before the swap deal. In swap deal, the present value of future cash streams are examined and an appropriate decision is taken. Next one is documentations. Swap transactions may be set up with a great speed. Their documentations and formalities are much less incomparable to loan deals. It is an evaluation of various future cash stream arising out in future contract done in the past. The terms of different contracts suit the interested firm's requirement. The deal will be enacted. Transaction costs. It is observed that the transaction costs are relatively low in swap in comparison to loan agreement, unlikely to exceed half percentage of the total sum involved in the swap agreement. Benefits to parties. Swap agreement will be done only when the parties will benefited by such agreement. Otherwise, such deals will not be accepted. Then termination. Swap is an agreement between two parties. It cannot be terminated at one's instance. Termination also requires to be accepted by counterparties. And last one is default risk. Swap deals are bilateral agreements. The problem of potential default by either of the parties do exist. So these are the features of swap. Let us go to interest rate swaps now. An interest rate swap is a financial agreement between the two parties who wish to exchange the interest payment on receipt in same currency on assets and liabilities to a different basis. No exchange of principal amount is in this swap. This is also known in the market as plain vanilla swap. Principal amount applies only for the purpose of calculating the interest to be exchanged under the interest rate swap. Maturities range from a year to over 15 years. Features of interest rate swaps are notional principal interest amount, whether fixed or floating, is calculated on the specified amount borrowed or lent. Parties do not exchange this period at this amount at any time. It remains constant throughout the life of the swap. Fixed rate. This is the rate which is used to calculate the size of the fixed payment. Banks or financial institutions who make market in interest rate swap quote the fixed rate. They are willing to pay if they are fixed rate payers in the swap. Bid swap rates. They are willing to receive if they are floating rate players in the swap. Ask swap rate. Fixed payment is equal to P into R into F. P is the notional payment, that is principal. R is the fixed price, that is rate, and F is the fixed day count fraction. Now floating cost. Floating rate as one of the market indices like LIBOR, London Interbank Offer Rate, Treasury Bill Rate, Primary Rate, etc., on which basis the floating interest rate is determined in the swap agreement. Floating payment is again equal to P into R into F. P is notional payment, R is floating rate set on the reset date, and F is the floating rate day count fraction. Trade date, effective date, reset date, payment date. Trade date. Fixed rate payment are normally paid semi-annually or annually. For example, it may be March 1, September 1, etc. The trade date may be defined as such date on which the swap deal is concluded. Effective date is that date from which the first fixed and floating payments start to accrue. For example, a 5-year swap is trading on August 30, 2002. The effective date may be September 1, 2002, and 10 payment dates from March 1, 2003 to September 1, 2007. Example for calculation of fixed and floating interest rate. Let us assume party X on a semi-annual basis pays 7% rate of interest on the notional amount and receives from the party Y LIBOR plus 30 basis points. The current 6-month LIBOR rate is 6.30% per annum. The notional principal is rupees 35 crore. Amount to be paid as per fixed rate is notional principal into days in period, that is divided by 365 into interest. It is calculation as per simple interest. And we calculate this, it comes to somewhere near 12,21,644 rupees. Amount to be paid as per the floating rate would be notional principal, which will remain same, days in period that will remain same, and interest rate will be 6.30 plus 0.3 divided by 100, which is 6.60 divided by 100. That will be coming to 11,67,833. In a swap, the payments are netted. In this case, party X pays party Y the net difference of 53,810 rupees. Now, types of interest rate swaps. Plain vanilla swap. It is known as fixed for floating swap. One party with a floating interest rate liability is exchanged with fixed rate liability. Period range from 2 years to over 15 years for a predetermined notional principal amount. Now, zero coupon to floating. Holders of zero coupon bond get full amount of loan and interest accrued at the maturity of the bond. The fixed rate player makes a bullet payment at the end, and floating rate player makes a periodic payment throughout the swap period. Alternative floating rate. Floating reference can be switched to other alternative as per the requirement of the counterparty. These alternatives include 3-month LIBOR, 1-month commercial paper, T-bill rate, etc. Alternative floating interest rates are charged in order to meet the exposure of other party. Floating to floating. One party pays one floating rate, say LIBOR, while the other counterparty pays another, say prime, for a specified time period. These swap deals are mainly used by the non-US banks to manage their dollar exposure. Forward swaps. This swap involves an exchange of interest rate payment that does not begin until a specified future point of time. Swaptions. Swaptions are a combination of features of two derivative instruments, that is option and swap. Options interest rate swaps are referred as swaptions. Buyers of the swaption has a right to enter into an interest rate swap agreement by some specified date in the future. Swaption will specify whether the buyer of the swaption will be a fixed rate receiver or a fixed rate payer. Buyer exercises the option, then the writer of the option will become the counterparty. Equity swap. Equity swap involves the exchange of interest payment linked to the change in the stock index. Example, an equity swap agreement may allow a company to swap a fixed interest rate of 6% in exchange for the rate of appreciation on a particular index, say BSE or NSE. Now let us go for swaptions. Swaptions is also known as a swap option, referred to an option to enter into an interest rate swap or some other type of swap. In exchange of an option premium, the buyer gains the right but not the obligation to enter into a specified swap agreement with the issuer on a specified future date. The classification of swaptions is based on the type of legs involved in the anticipating swap contract. Based on such a classification, there are two primary types of swaptions: payer swaption and receiver swaption. With the purpose of payer swaption, the purchaser obtains the right to enter into a contract which implies that he or she receives a floating swap leg in exchange for a fixed swap leg. Conversely, the receiver swaption delivers the right but not an obligation to enter into a swap contract in which the holder of the swap must pay the floating swap in exchange for the fixed swap leg. Now, in other words, different swaptions contain different clauses that determine the exercise dates. That determine the different swaps rate. The most common swaption styles include European, American, and Bermudian style. European swaption, a swaption that can be exercised only on the exercise of the date. American swaption, a swaption that can be exercised on any date between the origination and exercise date, as well as on the exercise date. Bermudian option is an option that can be exercised on several predetermined dates in between the origination and exercise dates. The swaption styles are crucial in selecting the appropriate valuation method. For example, European style swaptions are typically valued using the black valuation model. On the other hand, American and Bermudian swaptions, which are considered to be more complex relative to European options, are usually priced using black diamond toy or Hull white model. A commodity swap is a type of swap agreement whereby a floating or market or spot price based on an underlying commodity is traded for a fixed price over a specified period. The vast majority of commodity swap involve oil. The commodity swap is a contract where two sides of the deal agree to exchange cash flows which are dependent on the price of an underlying commodity. A commodity swap is usually used to hedge against the price of a commodity, and they have been trading in the over-the-counter markets since the middle of the 1970s. Commodity swap work like any other swap. One leg involves a fixed commodity price and the other leg a variable commodity market price. Unlike future commodity contracts, cash settlement is the norm. Example: jet fuel oil swap. Airline A enters into a 2-year jet fuel oil swap. Every quarter, Airline A receives the average market price based on a known price quote and pays a fixed price. Now, a commodity swap is a type of swap agreement whereby a floating or the market or spot price based on an underlying commodity is traded for the fixed price over a specified period. A vast majority of swap involve oil. Currency swap is an agreement in which the two parties exchange the principal amount of the loan and interest in one currency for the principal and interest in another currency. At the inception of the swap, the equivalent principal amounts are exchanged at the spot rate. So if you look into this example, what happens in swap? Firm A and firm B, they both agree to exchange their debt obligations in different currencies. Now, currency swap. In currency swap, a company A borrows a dollar and a company B borrows a rupee. They enter in a currency swap. What happens is company A gives to dollar lender and company B gives to rupee lender. And I gave the same example when I was starting the swaps. So it is similar kind of example where company B has taken a loan in Indian rupee in dollar amount, and company A has taken a loan denominated in rupee, and now they've exchanged their payment obligations. Now, currency swap can consist of 3 stages. A spot exchange of principal. This forms part of swap agreement, as a similar effect can be obtained by using the spot foreign exchange market. Continuing exchange of interest payment during the term of the swap. This represents a series of forward foreign exchange contracts during the term of the swap contract. The contract is typically fixed at the same exchange rate as the spot rate used at the outset of the swap. Re-exchange of principal on maturity. So these are the 3 kinds of or 3 stages of currency swap. Now, currency swaps, what are the benefits? Currently, swaps enable corporate to exploit their comparative advantage in raising fund in one currency to obtain savings in another currency. Currency swap permit corporate to switch their loan from particular currencies to another depending on their expectations of future movement of the currency and interest rates. It offers flexibility to corporates seeking to hedge the risk associated with a particular currency. A company no longer has to live with a bad decision if it has selected a wrong currency for its overseas funding operations. A currency swap can undo the damage. Currency swap can be used to lock into exchange rates of the longer period, and it do not require monitoring and reviewing. The currency swap mode can be chosen to restructure the currency base of the company's liabilities. Currency swaps are used to hedge the exposure to currency risk on future receipts, asset swaps, and payments, liability swaps, and to raise funds at the lower cost. A high degree of liquidity in the currency swap market ensures a speedy supply of principals ready to assume the opposite side of the transaction. In a currency swap, exchange rates at maturity is known as the outset. Early termination of swap contract may be possible by agreement of the counterparties. Currency swaps can be entered into at any time during the life of the transaction. They are being used to hedge. So here we come to end of unit 4. I hope you all enjoy this session. Kindly go through these slides and videos again and again to understand things. Thanks a lot.